life of an accountant can be tough. Many problems, long nights. It's all worth it though, because I do it for my CEO. And I guess my wife and kids too. I couldn't dream of a better life. After the raging success of the previous video, I had no option but to continue this series. So to all 100 viewers out there, thank you.
Love you guys.
Now last video I made you a master of debits and credits, plus you were introduced to the accounting equation. This part is going to go deeper on assets, and then we'll cover common types of assets that you'll see in your day-to-day work. In the last part, I said that an asset is everything the company has. Now this wasn't entirely accurate.
I lied.
An asset by definition is a resource owned or controlled by a business or economic entity that is expected to generate future economic benefits. So this means that an asset is anything that could be converted to cash, create revenue, or even reduce future expenses. Vague? Yes. Welcome to accounting. Now there are many types of assets, but we're just going to go over the most common ones. Cash. Now, are you really surprised that cash is an asset? I mean, what are you, a little baby? Is this baby's first little asset? Ooh. Cash is the blood that flows through the company. Without it, it dies. Cash is almost the definition of an asset, as, in a sense, the future economic benefit is cash. Now, cash is usually kept track of in a bank account. There is one issue with bank accounts. Transactions are not always done right away. Most banks run large transactions only during set times of the day. So for example, let's say your bank's last run is at 4 p.m. and you pay a vendor through direct transfer at 5 p.m. You'll record that transaction in your books, but your bank statement won't have it recorded. How do you reconcile that? With something called a bank reconciliation, or bank rec for short. Basically, it reconciles the bank statement to the accounting book balance by taking the bank balance, adding and subtracting the uncleared transactions, which will then equal the book balance. Pretty simple, right? Well, we're just getting started, so it's going to get a lot more complicated from here. Next is accounts receivable. Let's be honest, most people are not going to give you your money right away when you sell something. If you've ever lent your friend 20 bucks, you know exactly what I mean. Bro, I'm telling you, dude, I'll pay you back next week, trust me. Listen to my mixtape, it's going to pop off. And so to hold us over until we get cash, we debit something called accounts receivable, or AR for short. Remember how the definition of an asset is a future economic benefit? This is a prime example of this. The future economic benefit is the cash you will receive. But what if your buddy's hot new single doesn't get you out of the hood? And what if he can't pay you back? What happens? That's when a new account comes in the picture. Allowance for doubtful accounts. This account is what we call a contra account and will be used to record accounts receivable that are no longer likely to be collected. A contra account is an account that sits at either a zero or negative balance and is used to offset its related account. In this case, the contra account is used to offset accounts receivable. You may ask, why not just reduce the accounts receivable? Why keep two separate accounts that need to be added together? The answer is for clarity and transparency. Think about it like this. If you see $10 in accounts receivable, what does that mean? It could mean that you're really good at sending your goons to collect cash. Or if you're reducing your receivables, you could in theory have $1,000 where 990 is written off. Now that's a much worse scenario and shows that you're not keeping on top of collecting your AR or that you extend credit to risky customers. How would somebody know if it's the former or latter? All of this is important as transparency is a crucial element of the financial statements. What are financial statements, you might be asking? You're just gonna have to subscribe and find out. Inventory. Inventory is an asset that is going to be sold sometime in the future as part of business. Inventory largely falls into three categories: raw materials, things like wood, sheet metal, etc. Work in progress, called WIP for short. This is inventory that is being worked on. WIP is essentially the holding area until the inventory is complete and moves to the final category, which is finished goods. This is inventory that's ready to be sold. Each company has their own policy on how inventory moves from one category to the next, and some companies, like retailers that buy from factories, only deal with finished goods, so I won't spend any more time talking about this. Another aspect of inventory is accounting for the cost once inventory gets sold. In this, there are a couple of methods. First in, first out, called
Hi-ho, hi-ho,
It's home from work we go.
For short. This assumes that the first item to go into inventory will be the first to leave. So if you buy 3 items, the first one for 15, the next 2 for 20. If you sell 1 item, you'll reduce your inventory by 15 since that was the first one entered into the system. The pro is that the number is more accurate as you reduce inventory by the exact amount that it cost when you ordered it. The con is that you will need to keep track of each order to know how much to reduce your inventory by when you sell it. So tracking it will take much more work, which means much more money spent. Next is the average cost method. So if money isn't falling out of your pockets because you got an investment from BlackRock.
Come to BlackRock. Come to BlackRock now.
What was that? Like I was saying, average cost methods are used when you don't want to keep track of every individual purchase, as you will only need to keep track of an average cost that you will use when determining how much to remove when selling. Much easier, much cheaper. The basic formula is total value of inventory over total units. Using the same example, if we buy 1 item for 15, the average is 15 as 15 divided by 1 equals 15. Adding the next item for 20, we now have 2 items with a total value of 35. Now the average cost is $17.5. Let's say we sell an item, we will reduce the total value by our weighted average cost and reduce the number of units by 1, leaving us with $17 over 1 unit. Now if we buy 1 more unit at 20, we repeat the process. 20 plus 17.5 divided by 1 plus 1 equals $18.75 per unit. It's much easier to keep track of inventory costs as you don't need to keep track of every inventory purchase that is still in your possession. Capital assets, also called property, plant, and equipment. Capital assets are long-term assets, which in accounting, long-term usually means that it will sit in your books for over a year. The major types of capital assets are land, buildings, equipment, and furniture, although there are many more. The interesting quirk regarding capital assets is depreciation. Like AR, we use contra accounts to keep track of depreciation using accumulated depreciation. Let's say I move to the south, and so by law I have to buy a Ford F-150 Raptor. How do I record this? This purchase is simple, a $100,000 credit to cash and a $100,000 debit to our vehicle account. Now when depreciating, it becomes tricky as there are many ways to depreciate a capital asset, but I will go over the most common ones. Straight line. Straight line depreciation means that I will depreciate the asset by the same amount every year. You would use this for assets that typically depreciate evenly over its useful life. Let's say that the truck has a useful life of 10 years with a salvage value of 10K. Psst, salvage value means at the end of its useful life, I expect to get $10,000 when I dispose of it. I take the cost, subtract the salvage value, and then divide it by the useful life. So with our example, it's 100K minus 10K over 10 equals 9K of depreciation per year. Declining balance. Declining balance is when depreciation reflects a percentage of the net book value. Net book value simply means the net of the capital asset amount and its depreciation account. This is good for assets that depreciate more at the beginning of their useful life than at the end. In our example of a truck, declining balance would actually be the more accurate method to use. If we decide to use, let's say, 20% of depreciation every year, then on year 1 we would take the net book value of 100K because our NBV is 100K minus 0 times 20%, we depreciate 20K. On year 2, we would take the net book value of 80K, since now we did 100K minus 20K from the first year, we would multiply this new amount by 20%, so in year 2 you would only have $16,000 in depreciation, and so forth until you end up selling the asset. So how do you record depreciation? It's pretty simple really. You credit the contra account and debit a depreciation expense account. Another quirk is when you finally dispose of the asset. How is that treated? Let's say you get exactly $10,000 like you expected and you're using the straight line method. You would back the truck out of the capital asset account with a credit of 100K, then back out the depreciation out of the contra account for 90K with a debit, and then another debit to cash for 10K for that cash received. Let's say you come across the reddest of rednecks and he really wants your truck. He's willing to pay you $15,000. Now if you do that same journal entry as before, you're short 5K in credits since you must record 15K in cash instead of 10K. Where does that $5,000 balance go to? The difference would be called a gain on sale and would go to what we call a gain/loss on sale account. Now note, if someone gave you less than 10K, that missing debit would be considered a loss on sale and would go to the gain/loss on sale account. This will all be discussed in a future video covering the income statement. Side note on accounts. Some people may be asking, where are you pulling these accounts out of? The answer is, it really doesn't matter. You can name the accounts what you want, and you can number the accounts what you want. What really matters is how you set the account up in your accounting software. There are some common industry practices, but I don't want to limit your creativity, you artist you. This was a brief overview of common assets that you'll see in day-to-day work. We covered cash, accounts receivable known as AR, inventory, and finally property, plant, and equipment or capital assets. Tune in for the next part where we talk about something I'm not liable to discuss. Don't forget to like, comment, and share, and if you have any questions, also leave them in the comments below. See you next time. Peace!